When it comes to financing your dream car or must-have necessity, there are many misconceptions that can lead to costly mistakes. We will go over 5 such misconceptions with the use of Excel or Google Sheet. To start, we're going to use 3 car loans with different terms, loan A, B, and C, to find out how much does the loan actually cost you. If you want to learn how to calculate the monthly payments, interest rate, loan terms, or loan amount, see my car loan comparison video, but I placed the used formulas on the left for your reference. So let's start with the biggest misconception, that the car loan with the lowest monthly payment is always better. We have 3 loans here for $23,000. Loan B is for 72 months with 10.5 APR interest rate. Now the monthly payment will be $432 with a total cost of the loan over $31,000 and total interest over $8,000. Now if we have loan A with the same loan amount, but now the loan term would be cut to 48 months with 8.7% interest rate, the monthly payment would be higher, $569. However, you can see that the total interest we're paying on this loan is almost half of loan B. Now, if we compare it to loan C with 36 months loan terms and 8.7% interest rate, the monthly payment increases to $728, but we pay the least amount of interest. So you can see that the lowest monthly payment doesn't always equal the least amount of financing, and the APR rate along with the long term significantly affect the total interest. Second misconception is that loans with the same monthly payment will cost you the same in total interest. Let's look at this through an example. We have loan A and B for the same loan amount of $23,000. Loan A is going to be for 48 months at 11.5%, which equals to $600 in monthly payments, and total interest of $5,802 for the duration of the loan. Now loan B, if we increase the loan term to 60 months at 19.3%, we still have the monthly payment at $600, but now the total interest is more than twice the amount of loan A's. Now loan C is for less amount for 36 months at 12.2% and still has the monthly payment of $600, but the total interest you pay on this loan, because it's much shorter and for less loan amount, it's much less. So all 3 loans have $600 in monthly payments, but you can see the difference you pay in total interest depending on the other variables. Third misconception is that the loan amount is the final cost and includes interest. Let's say we have a loan of $23,000 for 48 months at 11.5%. So the monthly payment would be $600. Some people believe that the loan amount, the $23,000, already includes interest, but it doesn't. The total cost of the loan, you have to take the monthly payment of $600 multiplied by the loan term. If you subtract the loan amount, you see how much interest you're paying. The interest is on top of the borrowed amount. In our case, the $5,802 is on top of the $23,000 that we borrowed for financing of our loan. The fourth misconception is the total interest you pay on a loan is the amount you borrow times the interest rate. So we have a loan here for $23,000 again, loan term of 60 months, 9.3% APR interest rate. So the monthly payment will be $481. Now, few people assume take the loan amount of $23,000 multiplied by the interest rate of 9.3% to find out how much in total interest you have to repay to the car loan company. But that is not how much you would pay in total interest. You have to take into consideration not only the number of years you have the loan for, but also the amortized monthly payments. Meaning you take the monthly payments, multiply by loan terms, and subtract the original borrowed amount of $23,000. So the total interest is really the monthly payment times the number of months, and then you subtract the principal loan amount to calculate the total interest on the loan. The fifth misconception is that the interest rate and APR rates are the same. The interest rate only covers the cost of interest on a loan, while the annual percentage rate takes into account additional fees and charges. When comparing loan offers, it's better to use the APR rate because it compares loans apples to apples. Now, the formula to calculate APR is complicated, so you may want to either use an online calculator or ask car loan companies for an APR rate. But we are fearless and we'll break down the complicated formula to calculate APR into simpler steps using Google Sheets or Excel. So we have a $20,000 loan amount for 36 months at interest rate of 10%. The first thing we want to consider is any additional fees, such as origination prepayment penalties, documentation fees, etc. For simplicity's sake, we're going to assume simple interest. To calculate the total simple interest, you take the loan amount of $20,000, multiply by the interest rate of 10%, and times the number of years you have to loan. Now we have it in terms of months, so we have to divide it by 12. The second thing we have to calculate is the total fees that we have on this loan. So we already prepared that, and they total $750. If we add them up, it's $6,750. And if we divide it by the loan amount of $20,000, we get 0.34. Next, we have to calculate the number of days in the loan term. So we take the 36 months divided by 12 to convert it to years, and then multiply it by 365 to calculate the number of days, which is 1,095 days. Next is the most complex step, basically taking the interest charges plus fees that are divided by loan amount. Now we're going to divide it by number of days in the loan term and multiply it by 365 to get 0.11. So now the final step is multiply by 100 to convert it to a percentage, to an APR interest rate. By using the APR rate instead of the regular interest rate, we would end up paying an extra $425 in interest over a 3-year period. Now this demonstrates how car loan companies sometimes promote the lower interest rate to make their offer appear more attractive and luring customers to their dealerships without being transparent and disclosing the complete costs. So thanks so much for watching.